Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Canadian solar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.3 billion market cap. They're trading at $19 a share and they have 66 million shares outstanding. Canadian Solar provides solar energy and battery energy storage products and solutions in Asia, the Americas, Europe, etc. The company operates through two segments, CSI Solar and Recurrent Energy. The CSI Solar segment designs, develops, and manufactures solar ingots, wafers, cells, modules, and other solar power and battery storage products. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It doesn't look so great, their free cash flow. Negative 800 million in 2021. They did have a positive in 2022, but back to negative 800 million in 2023, and negative 1.3 billion in the trailing 12 months. So they seem to be bleeding cash, not sure why. Net income is a profit or loss on the income statement. It's revenue minus expenses. That is positive each year. It peaks in 2023 at 360 million. It's 300 million in the trailing 12 months. Really low margins. Net profit margin is between 2 and 5%. Net profit margin is net profit divided by revenue. It's a percent of your revenue you convert to net profit. Revenue is a sales for the company, and that grew a lot from 2021 to 2022, up 42%. Then up a little bit into 2023, 7.6 billion. Then it regressed, down 5% in the trailing 12 months. I know a lot of solar companies have struggled the past year or two with higher interest rates because less people are willing to get solar unless they can buy it outright. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 4.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 66 million shares. And we get a calculated stock price of an even 20. They're trading at 19, so they're trading at a 5% discount. It is a buy according to the model, but this is a tough one because they pretty much only have negative free cash flow. And the forecast for the future is also negative. I did give them a positive in 2027. I think they can turn it around, but it's definitely a risky play. There are 26 companies in the same industry as CSIQ, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They do spend a lot on CapEx, 1.7 billion, a lot higher than the median average. Their debt to equity ratio is pretty high. For every dollar of equity, they have $2 of debt. They have a big negative free cash flow, worse than the average. They rank 9th in market cap. They're trading at 1/2 of 1 times book value, which is a good multiple. They're trading at 4 times earnings, which is a crazy good multiple. So it seems really undervalued based on that. So why aren't people buying the stock and driving the price higher? Obviously they don't believe in the company. We can't look at their price to free cash flow, negative free cash flow. Look at their price to sales, 0.2. When a company has a price to sales around 0.1 or better, that means they're headed towards bankruptcy. They generate a lot of revenue, second most on this list, and they're still growing. Their 5-year annual revenue growth rate is 21%. If you put $10,000 into this company 10 years ago, you'd be on a true roller coaster ride. Right away, after a few months, up to 15,000. Then a few months later, you'd be in a red, a little under your $10,000 investment. Then a few months later, back up to $15,000. Then you would have dropped to below $5,000 and you would have been in a red for about 4 years. Then the stock blew up and your 10,000 would have been north of 20,000 and you would have been in the green for a couple of years. And then in the past 6 months or so, you'd be in the red. So a stressful stock to own indeed. Your total return over 10 years is negative 22%. Let's go through their first quarter presentation slides. They were founded in 2001, listed on the NASDAQ in 2006. They produce 61 gigawatts of solar energy, 20 gigawatt hours of battery energy storage capacity. They're in over 20 countries, and they employ over 22,000 people. 2023 revenue $7.6 billion, gross margin 17%, which is pretty good. Almost $800 million of EBITDA, earnings before interest, taxes, depreciation, and amortization. $274 million of net income, and an EPS of $3.87. And they have two divisions, CSI Solar, Recurrent Energy. I went to CSI for a year before I went to Buffalo, College of Staten Island. In 2023, they shipped nearly 31 gigawatts of capacity. And in battery energy storage, 1.9 gigawatt hours. In recurrent energy, 10 GWPs, gigawatt peak, that's their track record. 27 gigawatt peaks in the pipeline. That's in the solar part. In battery energy storage, over 3 gigawatt hours. And in the pipeline, 55 gigawatt hours. So a lot in the pipeline. Solar grows in Canada more than the average country. Look at the growth from 2008 to 2023. It looks exponential. Here's the electricity generation by fuel type. 35% coal, 23% gas, hydro 15%. Hydro uses water to generate electricity. For example, water flowing over a waterfall. Nuclear 10% and solar 5%. But solar has grown a lot since 2012. It was almost nothing before then. The solar PV module cost has gone down dramatically from 106 in 1975 down to 0.2 currently. PV stands for photovoltaic. It's the conversion of light into electricity that use semiconductor materials that exhibit the photovoltaic effect. If you're not sure what I mean, then you're not a physicist. They have a really wide reach. Right here is their headquarters in Guelph. They do have a footprint throughout the US, Austin, Indiana, San Francisco, New York City. That's where they do their manufacturing, Canada and the US. It looks like they also do manufacturing in China, Thailand, Vietnam. But it looks like they touch a lot of countries, Brazil, Japan, Australia. Here's a breakdown of their shipments by location. EMEA, Europe, Middle East, and Africa, 24%. China is their biggest, 27%. North America, 18%. Latin America, 12%. Asia, ex-China and Japan, 13%. And Japan, 6%. Here's a breakdown of the EBITDA calculation. The quarterly revenue, it was highest in 2Q 2023, 2.4 billion. For all of 2023, 7.6 billion. COGS, cost of goods sold, 6.3 billion. So gross profit, 1.3 billion. Operating expenses, 827 million. So they have a positive operating profit of 454 million. They did break even in the fourth quarter, but the other quarters look pretty healthy. Depreciation and amortization, 300 million. So their EBITDA is 800 million. And if you add back impairments, it's 850 million. That's adjusted EBITDA. Market cap, 1.4 billion, plus total debt of 3.6 billion, minus cash, 1.9 billion, plus 1.1 billion of non-controlling interests. That's how you get their enterprise value, 4.3 billion. Enterprise value is market cap plus net debt. That's how I define it. Market cap and net debt is debt minus cash. But they're adding back non-controlling interests. There's more than one way to skin a cat. So their EV over EBITDA is almost 1, 5.4 over 5.3. I always thought an EV over EBITDA below 10 is good. So they're 1, so that must be really good. But it is industry specific. You want to compare any calculation to other companies in the same industry. We saw earlier their debt to equity ratio was 2 on my chart. They say it's 2.1 here, but it's gotten a lot better. It was over 9 in 2016. The way they calculate is net debt over EBITDA. I was doing debt over equity. Total debt over EBITDA, that's 3.9, and it was over 11. That's improving a lot. Their cash has gone up a lot. It's now 1.9 billion, and restricted cash, 1 billion. Restricted cash is cash that's set aside for a specific purpose. So it is cash, but it's tied to something. For example, if you go to buy a car for $40,000 next month, and you had $140,000 of cash in your bank account, I would say you have $100,000 of cash, $40,000 are restricted cash. Revenue in CSI Solar is most of their revenue. It's around $2 billion a year. It has gone down from 4Q 2022 to 4Q 2023, But it didn't go down that much, and I've seen this number go down a lot, up to 70% for other solar companies. Recurrent is pretty low revenue. It was high in 2Q 2023, but it's pretty low every other quarter. The gross margins are okay. I like to see above 30%. A 12.5% gross margin for a supermarket is amazing. For a financial institution, it's terrible. So it is industry specific. Their margins on recurrent energy are really good, 40%. CSI only 12%. Operating income only $1 million for the fourth quarter. Last year, $136 million. And they spent $18 million of interest on their debt. They had a net loss of $3 million compared to a net profit of $100 million last year. Here's their gross margin in 2022, 16.5%. 2023, 15.3%. So it seems to always be in a similar range. Inventory turnover, COGS over average inventory. That's between 70 and 100. That's how many times a company sold and replaced its inventory. You don't want it to be too high or too low. If it's low, it could mean weak sales or too much inventory. When it's high, it may mean strong sales or insufficient inventory. Accounts receivables turnover is sales over average receivables. AP turnover, that's revenue over accounts payable. They do spend a good amount on CapEx. In 2019, it was $290 million, and it goes up every single year. They're projecting $1.8 billion for this year. Their total assets in the first quarter of 2021 was $6.8 billion. And you can see it grows over time. It was $8.3 billion by 1Q 2022, $9.8 billion by 1Q 2023, and now it's almost $12 billion as of the end of 2023. And their liabilities went up as well, from $5 billion to $8 billion. But their equity doubled. It was $1.9 billion. Now it's $3.7 billion. Equity is assets minus liabilities. Let's look at a company on Simply Wall Street. Its last price, 17, 1.2 billion market cap. Down 12% in the past week. Down a whopping 54% in the past year. This stock has been struggling. It looks like it IPO'd in 2006 at $15. Then it shot way up to 47 after 2 years. That was in 2008. It fell to $2 in 2011. It grew a lot over the next few years, then fell again, then blew up to 61 in 2021, its all-time high. But it's come down since then, so this stock is all over the place. 9 analysts priced this stock at $26. The revenue forecast for 2024 is $7.7 billion, next year $9.3 billion, after that $10.2 billion. The free cash flow forecast is negative every single year. So I put in these negatives in 24, 25, and 26, but I did assume a positive in 27. They have to be positive at some point, because if they're not positive at some point, they will go bankrupt. Their revenue back in 2013 was $1.3 billion, and then it more than tripled by 2018 to $4.1 billion. And it didn't do much from 2018 to 2021, and then solar got pretty popular around this time, and their revenue blew up to $8 billion. It has come down a little bit, down to $7.2 billion. The CEO's salary is $1 million, and he's been CEO for 23 years. I like to see that when I invest in a company, a CEO who's been around a long time at the same company. 46% of the company is owned by institutions, 21% by insiders, 20% by the general public, 7% by private companies, and 6% by hedge funds. The CEO, Sean Shu, owns 21% of the company. He's the biggest shareholder, then BlackRock. Mackenzie, the Canadian investment fund, owns 6%. Grantham, the Boston investment manager, owns 4%. Vanguard Invesco. The Guinness Beer Company owns 1.6%. Citadel, 1%. I thought more Canadian banks would own this stock. Not as many as I thought. Their employee count went from 7,700 up to 22,000, and the ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.